Hey, what's up, stock compounders? Brad here. So it is that time of the week again for our Q&A session. This week we're going to focus on the magic formula. It's been 1 year since I started testing the magic formula in my son's, tax-advantaged account. And, the results have been pretty good. 64% on that first batch of 5 that I invested in 1 year ago. And of course, 9 months ago, 6 months ago, 3 months ago, I bought additional batches, and you can see all of that in a video I put out a few days ago. But this week, I want to focus on questions around the magic formula that any of you might have. So let's dive in to the ones that you guys submitted this week. I put one here. If the magic formula works, why doesn't everyone use it? Okay, and this is a common question that people have. It's actually addressed in the book, The Little Book That Still Beats the Market by Joel Greenblatt, where he lays out the magic formula investing approach. Well, it doesn't work all the time, okay? It doesn't work every year. It can really underperform the market in any given year. The magic about it is if you do it consistently over 5, 10, 20 years, the back test, right? The back test data shows it's going to outperform. Does that mean it necessarily will in the future? No, it doesn't guarantee that. But the reason not everyone uses it, it's hard to stick to, okay? It's hard to stick to a mechanical investing approach where you don't know the businesses, you're just blindly following a screener. If it underperforms when you're getting started, and this is actually something Tobias Carlisle talked about when I asked him through Investing with Tom, what percentage of people who start using the acquirer's multiple, similar question could be asked of the magic formula, actually stick with it for a decade or 2 decades or 3 decades? And Tobias responded, it really depends on how it works in the beginning, right? If you see results right away, you're much more likely to stick with the strategy. If it doesn't work in the beginning, you're likely to ditch it because there's not a lot that's keeping you with the strategy if you don't see results right away. It's hard to have faith in an approach like this where you're kind of blindly just picking stocks that show up on this screener. So, that's a big part of why not everyone uses it. To be determined whether it works, at least the iteration of it that I'm using. Why isn't there an ETF that does this for you? Might be popular. Even more lazy. Yes, I love the even more lazy. Actually, the thing that I'm doing, I wouldn't say it's a lot of work, but, it takes me about 3 hours each quarter to run all the filters through, the top 58 or so stocks that I get from the Magic Formula screener. So it's a bit of work, but it's only once every 3 months. I think there is an ETF for the acquirer's multiple, okay? I think Tobias Carlisle has come up with something for that. I don't know why there's not for the Magic Formula. It's a great question. I think there's probably an opportunity there for someone. So that's an interesting question. Next one, have you considered applying a magic formula approach to non-US stocks? Absolutely, I have. There was a service that I used a free trial of. What was that? I don't remember. It's a really powerful screener that allows you to screen stocks globally according to different strategies, and the magic formula strategy was one of them. It may have been Guru Focus or something like that, but it's a fairly expensive service on a monthly basis, so I didn't continue that, and I don't know how accurately uses, the nuances that Joel Greenblatt really incorporates into the magic formula to calculate both earnings yield and return on invested capital. But I think there's probably a lot of opportunity there to apply this framework of the magic formula to stocks outside of the US. Could be a very interesting approach for those of you who don't live in the US, and even for those of us who do. It's fairly easy to buy stocks outside the US for US residents using platforms like Interactive Brokers. So could be an interesting thing to explore. Question 2, do you have concerns that the magic formula list has too many eyes on it? Could this diminish the benefits in the long term? That's actually the big concern that I had that caused me to kind of develop my own filters, to lay filters on top of the raw kind of magic formula investing approach laid out by Joel Greenblatt. So I do have concerns about that. I think there's a lot of, it's funny, whenever I, look up those 58 magic formula stocks to see what super investors own them in Dataroma, there's a few investors that continuously pop up as having a very small stake in quite a few magic formula stocks, okay? So I know they're looking at the magic formula. I think there's probably a lot of institutional investors, fund managers that are kind of keeping an eye on the screen as kind of the top of the funnel to get ideas, to get new ideas. So I do have that concern, and I've talked about that in videos in the past around the magic formula. So I think there's probably something to be said for, doing some tweaks, some intelligent tweaks to the magic formula in order to gain a bit more performance, to combat this factor that there's so many people who are looking at this screener. What do you think would be a good approach to invest every 2 weeks or so from automatic paycheck funding into an account buying stocks from the magic formula? No commissions would apply, presumably because I guess because most brokers don't charge commissions anymore. Rather than buying an index fund every 2 weeks, buy one or more magic formula stocks every pay period. Change these basket of stocks every year or other interval when magic formula stocks change. To me, that sounds like a lot of work, quite frankly. Because if you're buying a stock every 2 weeks, a magic formula stock every 2 weeks, you've got to maybe run like a random number generator on, say, the top 30 magic formula stocks, pick the stock, buy the stock, and then, after a year, every 2 weeks, you're going to have some activity. It's, in my opinion, a lot of tinkering with the portfolio. I think what might be better is just let the money pile up and deploy it every 3 months or so, like what I'm doing in my magic formula approach. I think that's probably a more efficient use of time by doing batches like that rather than continuously investing over the year. So that's how I would approach it and how I am approaching it. The recent 5 stocks you have picked, few of them have run up more than 50% year to date. L Brands, Dickies. I mean, it's just kind of the nature of the market. A lot of stocks have run up this year. The whole market has run up almost 50% in the last 12 months. So does it have more room to run this year? I don't know. That's in my too hard basket. I have no idea about that. Shouldn't we add a criteria to choose only the ones that have not performed well year to date? So to me, this is kind of getting into short-term tweaking of the magic formula portfolio, which that's not really my game. Okay, I'm playing for the long run where you're going to have frothy periods, you're going to have depressed periods. The idea of tweaking the portfolio to take maximum advantage of those kind of timing elements, assuming we have any predictive ability about what's going to happen the next 3, 6, 12 months. I'm not assuming that about myself. I don't think I have any predictive ability around that. So to me, this question is applying more work to the magic formula portfolio And I don't really think there's going to be a net benefit over the long run. This is more active than I think the Magic Formula portfolio is designed to be. So that's my 2 cents on that one. But good question. Frank, what do you think about Tobias Carlyle's opinion of return on invested capital being a mean reverting factor? Would you ever try the acquirer's multiple approach, and which approach do you think is better? Yeah, so I have read the acquirer's multiple. I'm actually trying to incorporate some acquirer's multiple stuff into Ticker. So Ticker Terminal recently put out a screener, which is only available to, I don't know, kind of power users of Ticker Terminal. It's in beta. It's like pre-beta, where you can only get access if you've been using Ticker for a while. But you know, the big issue for me with the acquirer's multiple approach is, first of all, it's a paid service, okay? So in order to access all the investable ideas in the US, you've got to pay a certain amount, I think, per month to access that screener. There is a free screener. It's just like the largest 2,000, maybe not even that many, largest 1,000 companies in the US, which, you know, personally, I prefer the Magic Formula because it's free. And I think the performance is probably quite comparable, at least if you're doing the strategy of buying and then selling after a year, like the Magic Formula does. I believe that's how the acquirer's multiple approach works as well. I don't know which one is better, okay? You can't really backtest Joel Greenblatt's particular approach because, you know, he doesn't lay out the exact formulas that he's using to populate the Magic Formula screener. There's some kind of nuances. If you read the appendix of the little book that beats the market, you can see it's not black and white. And in terms of the acquirer's multiple, I think that's a little bit more black and white, but again, it's a paid screener. Tobias Carlyle says there's a little outperformance over, you know, decades of back testing for the acquirer's multiple. But, you know, I have no way to verify that. And so I don't know if it's statistically significant. I don't know how the data was parsed. So, you know, I'm not putting a lot of weight on Tobias's claim that it outperforms the Magic Formula. In terms of ROIC being a mean reverting factor, you know, I think there's probably some truth to that. Earnings yield, you know, the whole idea behind the acquirer's multiple is that earnings yield is also a mean reverting factor. So you're buying companies that are very cheap, expecting them to come, you know, back towards the average in terms of cheapness. So I think there's probably some element of truth that both, right, are mean reverting factors. But the way I'm doing it, I'm holding for longer than a year, okay? So I think return on invested capital, you know, it's a more important factor to me than if I were applying the acquirer's multiple and just holding for a year and just waiting for that kind of mean reversion to take place, which actually doesn't usually happen over just the course of a year. According to Greenblatt, if you buy a company at a discount to fair value, right, with the margin of safety, it can take 2 or 3 years for the market to, you know, accurately price that company, assuming you've done good valuation work and come up with an accurate estimate of fair value. So, you know, there's a lot in here to unpack. But the short answer is I don't know which one is better. The Magic Formula is free. I'm a cheapskate. I'd rather put, you know, any fees that I would be paying for a service directly into stocks, like Magic Formula stocks. So that's how I answer that one. What made you choose the Magic Formula over the acquirer's multiple? So I just answered that one. I'm glad those are back to back. That makes it efficient here. Greenblatt explicitly states in Richer, Wiser, Happier that any tweaks to the Magic Formula made investors underperform the automated version based off his research. Yes, he speculates that this is because it allows investors to project their hubris and tendency to think they can outperform. With that being said, do you make your own changes or do you use the given formula exactly as given by Greenblatt? Leading question, Shane. Objection. I make tweaks, okay? I've applied some of my own filters on top of the magic formula. I am well aware of this issue that, you know, if you give people some leeway to decide which magic formulas they want, stocks that they want to buy, the data shows that they underperform. But what Greenblatt said about that is, you know, someone will look at the stocks in the screener and they'll actually kick out certain companies because they've seen them in the news and, you know, the company is in the doldrums, right? Nobody wants to own that company and everyone knows it. And so these are the stocks that people are tossing out. And they're the same stocks that where the price is quite a bit lower than what the value is, right? These are the opportunities. And the price has just been pushed down because of the market sentiment. All right, so you can't really trust, you know, your sentiment towards a company to guide, you know, whether you should buy it or sell it. It's usually the opposite that you should do. So I think that's Joel's big argument for not getting too involved in the process of picking magic formula stocks. Now, I am not, well, what am I saying here? What am I not doing? I'm not using qualitative judgments about which companies to buy and not buy that are in the magic formula screener. I'm using very thought out filters for doing so. Do great investors own these companies? Are there VIC write-ups? Is there a large insider ownership? Okay, these are all factors that have been shown to correlate with positive gains, right? Positive over the average, alpha, so to speak. So, you know, I think they're sensible filters. I don't think I'm just using judgment that's actually going to work against me in making these tweaks. So that's how I would defend my approach to doing it. And that's not to say my approach is the best approach. I'm sure there are probably better approaches out there where people have figured out, you know, here are the few tweaks that are just the best in terms of what the research has shown, in terms of return correlations and all of that. But, you know, I came up with the best I could and I'm applying it and I'm trying to figure out, all right, does this work? And it's probably going to take 5 years, I would say, at a minimum to see, okay, this works, I should keep doing it, or I got to scratch this whole thing. It's not working. So was wondering why you've decided to use debt to operating earnings ratio and not just, for instance, debt to net earnings or debt to free cash flow. Is there any advantage of your ratio over those latter debt indicators? So the big reason I use debt to operating earnings is when you get into net earnings, you get into free cash flow, there's a lot more ways to influence the numbers, okay? Operating earnings is pretty high up, right, on the income statement. So I like it. It's more of a pure metric, in my opinion. So that's primarily why I use operating earnings as opposed to some of these other earnings metrics or earnings proxies. Quite some pharma stocks showing up in the screener. Yeah, that's true. Seems like sometimes that is a prudent way that the market already discounts patents that will expire in the near future. Does it make sense to exclude pharma from the list or to check the major 2 to 3 patents? Yeah, I don't think it's a big deal if you want to exclude pharma from your magic formula stocks. Um, I haven't seen any studies where, the magic formula results over time, including pharma versus excluding pharma, what those look like. Um, I haven't excluded pharma. And yeah, checking the 2 to 3 major patents, that would be another layer that I would really call active investing versus a mechanical approach like the magic formula. So that's kind of moving over into a new realm above and beyond kind of what I'm committing to with the magic formula. So that's not something I'll be doing, but who knows? Maybe it makes sense for some of you out there who want to test your own variation of the magic formula. How can someone make money using magic formula, and when do you figure to sell a magic formula investment? Well, the same way people make money buying stocks, in the stock market, buying index funds. You make money using the magic formula when the companies you're investing in appreciate in price, they pay out dividends, all of those good things that happen, anywhere else in the stock market. When you figure out how to sell. So I don't actually have an answer for that yet. I've given myself 2 years, all right, from when I started the magic formula investing approach. I said, all right, magic formula calls for 1 year. I'm going to do 2 years because there's actually a report Joel Greenblatt put out where, right when he was starting the magic formula, he decided, all right, we're going to have a test case where we automate the magic formula for this group of people. And then for this group of people, they're going to pick their own magic formula stocks and do it themselves. All right. He wanted to see how those two methods would perform against each other. Now, a subset of the people who are doing it themselves, there was one case where, they bought the initial batch of magic formula stocks and they didn't do anything, okay, over 2 years, right? The study was over 2 years, and they didn't sell and then buy more after a year like they were supposed to. They let it ride 2 years. And that was actually the best performing account where they were doing it themselves, okay? And so I think there's potentially some extra juice to be squeezed out of this magic formula investing strategy by incorporating more patience, all right? Longer hold time. So that's part of what I'm testing here. 2 years, and then after 2 years of buying the magic formula stocks, I'm going to figure out, okay, which ones do I want to sell and which ones do I want to hold on to? And I haven't yet figured out what my process is for deciding if I want to sell. And I've got another year to figure that out because it's already been a year since I bought my first batch. So to be determined. What percent allocation at cost are you giving the magic formula picks? So this magic formula portfolio is in an account for my son. He's got about $7,000 in there. And I'm putting $100 into each of these magic formula picks. So it's about 1.5% at cost right now, 1.5%. As time goes on, it'll become a smaller and smaller allocation because I'm planning on keeping that $100 per magic formula stock consistent, at least in the near future. So with magic formula and shameless cloning, how do you justify being in two boats and conflicting philosophies? I don't feel conflicted at all about these philosophies. Magic formula, it's something I'm testing. It's something that makes sense intellectually that, okay, yeah, maybe this thing does outperform over time. So I'm testing it, all right? With shameless cloning from Pabrai, from Li Lu, from other super investors, it's a very different approach. Okay, it's completely different, and it'll be very interesting to me to see which strategy outperforms over 5 years, over 10 years, if I'm still doing both approaches for that long. I am fascinated to see which one does better. And I mean, probably I'll just take the one that, hopefully there's one that's clearly doing better. And hopefully it's also beating the market. Because if it's not beating the market, if neither of these are beating the market, it's time to just buy an index fund. All right, it's time to hang up my hat and admit, hey, I can't beat the market. I'm going to join the market. But yeah, I don't see it conflicting at all. It's really, I see the merits behind both of these approaches. I'm going to test them both and collect data and see how it does. Of these 20 stocks, which one would you go for 10%? I can't really answer that because I haven't gone into the businesses in these stocks. I've actually bought 25 Magic Formula stocks so far. Okay, a year ago, 9 months, 6 months, 3 months, and then I just bought a batch a few days ago. So I don't know the answer to that. I don't think any of them at this point would I make a 10% allocation. It was fun to see AltaFox Capital. They just put out their highest conviction idea for the quarter on Twitter, and it was IDT, which was part of my Magic Formula stocks batch back at the end of March of 2021. So it was pretty fun to see Connor Haley buying one of the stocks already in the portfolio in IDT. Let's see, would you consider doing this Magic Formula investing in your normal brokerage account at some point? Yes, absolutely. If I really see outperformance in the Magic Formula over over the market as a whole, over my active portfolio, I have no problem at all dedicating a lot more of my portfolio to the Magic Formula approach. I mean, I'm experimenting for a reason, right? I'm experimenting because I want to see how it does. And if it does really well, I'm piling in. Absolutely. I have no problem doing that. What do you think about IDT? There you go. AltaFox Capital thesis. So I haven't read the thesis yet. I think it was just yesterday that AltaFox released this new idea. Would you consider making it an investment other than your Magic Formula approach? Potentially, yeah. I'm gonna take a look at what their thesis is for the business, and see what I think. See if it makes sense to me. See how comfortable I am with the thesis. What the kind of risk reward is with IDT. So potentially, I'm gonna have to look at that. How has your modified Magic Formula portfolio performed versus the original Greenblatt version since you started? That is a great question. I don't know. I haven't been tracking how the Magic Formula would have performed by the book as laid out by Joel Greenblatt. Part of the challenge with this is, the way Joel Greenblatt recommends to do it is to randomly select, say, 5 or 6 stocks each quarter. But how do you test the performance of a portfolio that's randomly generated? Okay, especially over the course of a year, there could be a quite wide fluctuation in outcomes for performance with a randomly generated portfolio like that. So this is a kind of an unanswerable question at that level. But to be more direct, I haven't tracked any iteration of sort of a straight Magic Formula approach as laid out by Joel Greenblatt. So I don't know. But I know a number of you are also running Magic Formula portfolios. So the more of us who can share, how our performance is, and what we're doing, if we're doing any tweaks, if we're not doing tweaks, comparing notes, that would be very helpful to come together and kind of share those results and try to learn from each other what might be working better than other versions, other modifications of the approach. And lastly, do you want to reject acquirers multiple claims? Why you choose magic formula over acquirers multiple? We touched on this before. I'm not rejecting acquirers multiple claims. I'm just too much of a cheapskate, right? In an account for my son that has $7,000, you know, if I were to, you know, use some of that or whatever to pay for an acquirers multiple subscription, it just eats into it, right? It's like paying a fund manager fees for breathing. I'm just not interested in that when there's an alternative available for free that seems to be working pretty well, and I can really wrap my head around. So, you know, potentially moving forward, I might test some acquirers multiple strategy, just using ticker, using the screener and ticker to screen for enterprise value over earnings before interest and taxes. That's one of the metrics that I can screen for. I could even do it globally if I wanted to. It's an incredibly powerful service, Ticker Terminal. So I encourage you guys to jump in there. They don't charge anything yet. It's still in beta. You're not going to be able to access the screener yet, but potentially you might be able to access the screener before, you know, they start charging for subscriptions for that service. So hit me up if you want a link to get into that. I don't make anything. Like I said, they're not charging for the service at this point. So anyway, guys, that was sort of lots of questions about the magic formula. And I just wanted to jump in here real quick. This is Investing with Rose. She's got a great channel. She has some phenomenal magic formula content. She gets so many views, right? She is the magic formula queen on YouTube, far and away. So I just wanted to jump into some comments to see, you know, what are people generally wondering about or thinking about in regards to the magic formula. This video was just put out, 4 months ago or so, so it's pretty fresh. You could ignore this Yahoo at the top here. That's yours truly. I get excited when people reveal their portfolios. Anyone else, or am I weird? No, I get excited too. It's fun to see when someone has the beautiful pie chart of what they're investing in and all that. I don't know how particularly helpful it is for viewers. I think, you know, it's perhaps more valuable to actually share, like, you know, what you've learned and the investment process rather than here's what I own. But it is fun. It's kind of looking behind the curtain of what people have actual money behind. I love how open-minded Rose is about investing. I read an article of investors that made up to $500,000 within 2 months from shorting. So please, I'd really love more tips and clues on how to outperform the market and make such profit using options. Please don't do that. Oh man, there's a lot of this. How do I make $500,000 in 2 months, right? Stay away from those opportunities, please. Those will generally get you into big trouble. Some of them will go to shit, actually. I guess Rose said this in the video about magic formula stocks that she's buying. That is absolutely true. I've been pretty fortunate in my magic formula portfolio so far. I have only like 2 or 3 out of the 20 that I bought in the last year that are down, and they're not down very much. So, but it's true. You know, this is why we buy 20 to 30 magic formula stocks per year. At least that's what's recommended from Joel Greenblatt, because some of them are going to go down, right? Some of them are going to do very poorly. But you know, there's going to be some outperformers in there as well, some shining stars, and those are really going to lift the whole portfolio. At least that's the idea. So we don't care about that. That's just, it comes with the territory. Make sure it's a year and a day, so you get the cap gains rate, not short-term tax rates. So this is, you know, when you sell after a year, according to the buy the book magic formula approach, if the stock is down, you sell it just before a year, a day before a year, and if the stock is up, you sell it a day after a year. So you get that beneficial tax treatment in the portfolio, assuming you're not in a tax advantaged account. This seems like a lot of work for Magic. It's actually not very much work. I mean, if you are outperforming the market using the Magic formula by even a couple percent, that's going to make a huge difference over 2 or 3 decades, 4 decades, 5 decades. It's going to make a huge difference. So spending a couple hours every 3 months, or maybe you want to do even less work, and maybe you just do it every 6 months, right? You buy 10 or 12 Magic Formula stocks every 6 months. You could do it that way as well. But it's really not a lot of work. You know, if you want to know what work is in investing, try reading annual reports, right? Try studying individual businesses until you find one that's clearly a winner, right? It is a ton of work. So the Magic Formula is not a lot of work, but I guess it's all about your perspective. It's all relative. Wow, lots of spam replies here purporting to be from Rose. Don't fall for it. So, you know, Graham Stephan, I noticed he just put out a video about this. There are a lot of spammers out there, and they come up with really clever names like pinned by Stock Compounder or pinned by Rose. Be careful, all right? I will never put a WhatsApp number in the comments. I'm never going to try to sell you anything. I'm not going to talk about Bitcoin in the comments unless I make a video about Bitcoin, which I rarely do. So, you know, use your sense, guys. Use, you know, be smart about the comments. Good looking out, Rose. You got me on this journey. Great, perfect timing. Yeah. I think there's not many more questions beyond this point. You can see the likes of the comments really start to drop off. So anyway, guys, just wanted to tackle a few of these comments from the most popular video right now on the Magic Formula in YouTube. So hope you guys enjoyed this Q&A session. It was a bit of a different flavor than usual. We'll be back to our regular programming next week where you can ask whatever you want, okay? No limits. So we'll have some fun with that one next week. Anyway, guys, thanks for being here, and I will see you all in the next video. Take care.